Hey everyone, welcome back to the Blueprints for Better Benefits. If you're a part of your company's legal or compliance team, or even if you're in HR or finance, trying to wrap your head around your fiduciary responsibilities, this episode is for you. Because today we're pulling back the curtain on something most brokers don't explain very well, and that's the legal compliance responsibilities that come with self-funding and how to manage them without fear. So today we're breaking it all down, what ERISA really requires, what legal teams need to know, and what smart employers are doing to de-risk the process. Rodney Sr., where are we headed today?
Yeah, thanks, son. Yeah, there's a lot to this, but actually it's less frightening than most employers realize, which is why we wanted to put this information together. So, yeah, so basically, when we first meet with an employer, legal is often the last ones to come to the table. But the problem is it's their name on the plan documents. So they really need to be involved from the very beginning. And that's what we advocate for at Triforta. The legal team, they're the ones responsible when a claim goes sideways or when the Department of Labor shows up. But they're rarely included when funding models are discussed in the beginning of implementation. So when plan designs are restructured, that's where the important part is. So that silence, though, and them not being there, it's a liability. So this episode, we felt super important. It's about empowering legal teams to be the protectors, not the bystanders. Because once they understand what's involved and how the best plans are actually built, they go from nervous to confident really fast.
Okay, so let's walk through the top questions legal teams usually ask or should be asking.
Yeah.
And we'll add some real world stories and some gold standard tips on that. So who is the official plan sponsor and fiduciary?
Yeah, so that doesn't change when moving from a fully insured plan to a self-funded plan, the employer, period. So ERISA is really clear. So the employer is the fiduciary responsible for managing the plan in the best interest of its participants, all your employees and their dependents. So for example, a CFO once said to us, well, our broker handles that stuff. We hear that a lot, but that assumption is very dangerous. Brokers can't be fiduciaries. That accountability ultimately sits with the employer. So really our advice and the pro tip is appoint in your organization a named fiduciary in the plan documents, and then document any delegation of that authority ahead of time.
Okay, so who drafts the legal plan documents?
Yeah, good question. So, many rely on the TPA, but unfortunately the TPA that provides them, those are just templates. Typically, they're not really built for each employer specific desires or customization preferences. So they need to be reviewed and customized and owned by the legal team. So, for example, one employer we supported had never updated their SBD since 2017. That's their summary plan document, right? So it had no override provisions built into it, no discretionary authority to give them flexibility on making adjustments on how claims are paid, especially in a high-risk situation, and expose them to all kinds of risk. But once we came in, did a full audit analysis, we rebuilt a custom plan document that allowed the executive team to make exception-based claims approvals and protected them completely legally from discrimination or inconsistent enforcements. So the advice is, or the requirement is, you need to include discretionary authority. And those clauses and employer override options and document strategy from the very beginning.
So what happens if an employee sues over a denied claim?
Yeah, and that has happened. We've seen it. So, but without proper documentation, the employer is exposed, unfortunately. And we see this too many times. And the court usually sides with the employee. So another example I can think of, a company we advised had to settle a claim out of pocket because their appeals process wasn't followed correctly. Why? Because they didn't have one. It was never part of the plan document. So that's the start. right? So the key is you got to build and follow a clear appeals process and get also insurance. Fiduciary liability coverage is super important.
So who ensures HIPAA compliance with all the vendors?
Yeah. So every time you look at a vendor contract, the employer does, obviously. So they ensure HIPAA compliance. And we do as the advisory firm at Triforta. But each vendor, the TPA, your PBM, your stop loss carrier, all need to have a signed business associate agreement. And you need, as employer, internal controls. So another example, I can think of, employer didn't have a privacy officer. So when a vendor emailed protected information to the wrong person in the company, it created quite a scramble. So with the right policy in place, you get to manage that risk up front. So the key is assign a HIPAA privacy lead internally and keep a master file of all the business associate agreements available.
Okay, so if I was the legal team for an employer, what's our exposure in the event of personal health information breach?
Yeah, protected health information, but yeah, it's always the personal health information, typically of employee or one of their dependents, right? So, yeah, so that depends on what's in the vendor contracts. Many have liability caps or worse, no indemnification at all. So, there's an example. Once we flagged a TPA contract that limited liability to only $10,000 for a PHI breach. So, gosh, that wouldn't even cover 1 month of legal fees, maybe even 2 weeks of legal fees, right? So always red line contracts. Have your counsel review indemnification and breach language. And if an employer doesn't have in-house counsel, well, we can provide that and bring in our outside counsel to help with that. And we do that all the time.
Okay. So what role does the captive board play?
So you're speaking about a captive. So say we put an employer into a self-funded captive, and there's some great ones that we work with. But so think of a captive like a co-op, right? So there's a board at that captive, and it governs the collective risk pool. They also set the guidelines, and they help select the right and best vendor partners. So in one of the captives that we work with regularly, a large employer pushed for a change in stop loss. So one of their large employer members pushed for a change in stop loss underwriting after a bad renewal. So they just had a bad year, but they had advocated for some changes that they felt would not only benefit them, but everyone else within the captive. And so the board heard them, voted in favor, and every member benefited in that case. So that's what the board is there to do. So when we look at potential captive membership, the key is to join a captive with really strong governance and transparency, and assign a rep from legal or finance to help you monitor that.
So can the legal team legally override a denied claim?
Oh yeah. They certainly can, but only if your plan docs allow it. So as I mentioned, things have to be documented and they have to be followed consistently. So as long as they're in the plan documents, it's allowed. And if the override process is documented and non-discriminatory, that's a key rule or key term. Can't be discriminatory at all. So you have to apply it consistently in all situations. So there's another example. A client had a high dollar denied claim for life-saving treatment, but their plan had a discretionary override clause. So because they had that clause already in place, they were able to approve it without fear of any future liability. So that was really important. And these situations, while they don't come up frequently, they can and do come up, and that discretionary clauses need to be in place so they can make those business decisions for the benefit of their employees and their employees' dependents. So the tip is that you use employer override sparingly and consistently, and always keep legal in the loop when something is coming up, when an exception is being applied.
Right. So what if we want to switch vendors mid-year? What happens then?
Yeah, no, that's a good thing to consider, and making sure that there are conditions in place. So one of the things that, well, bottom line is you can switch vendors. So,
Okay.
it's, something could go wrong, and you want to give yourself an option to change vendors and not be locked into a vendor throughout the entire plan year if there's something that's not working. So that's a great thing about being self-funded is, if you're locked into a fully insured plan, you can't change vendors and carriers without changing your renewal date. Well, in self-funding, you can't. Everything's a la carte. All these pieces are put together, so you have the option to make changes and basically plug and play like an erector set.
Mhm.
So, but the key is you'll want data portability, and you'll want no exit fees, and you want a clear transition language. So the key is to make sure contracts include data ownership clauses, and that avoids hostage situations with your data. So you don't want to be handcuffed.
This segment is brought to you by the people and platforms that make this show possible. First, Triforta. If you're an employer who's tired of runaway renewals, bloated, fully insured plans, and the feeling that your benefit strategy is working against you instead of for you, then hear us clearly. You do not have to play that game anymore. Help business owners fix broken health insurance. We bring cost containment strategies, self-funded captives, data intelligence, and real-world case studies that routinely save employers 6 and 7 figures without cutting benefits. If you want a benefits plan that actually rewards results, visit triforta.com and download our blueprints for better benefits. And second, Aperionics. If you run an insurance agency and you're still drowning in manual quoting, data entry, or commission reconciliation, you're leaving more than time on the table. You're leaving money. Aperionics is the automation layer built by insurance people for insurance people. AI quoting for carriers that don't have APIs. Instant policy data extraction, commission statement automation, proposal generation in seconds, not hours. Aperionics reduces operating costs and gives teams their time back so they can work at the top of their license. Learn more at aperionics.com. That's IRONIX.com. Triforta and Aperionics. 2 companies, 1 united mission. Fix what's broken, elevate what's possible, and help real people thrive. Now let's get back to the show. Understood. Okay. So what are our non-discrimination testing obligations like?
Yeah. Well, self-funded plans, they must pass a Section 105H testing. So that's the code that applies. And that ensures that highly compensated employees, HCEs, aren't favored or aren't giving special favor over everyone else in your employment. So if you fail a non-discrimination test, that's going to equal tax penalties. So it's really important to just make sure that you're looking at all these things carefully each and every year. And that has a lot to do with employer contributions. You can't have 100 employer contribution for key employees and have an imbalance for all your other employees. Now they could have lower contributions, but it needs to be within some tolerable limits. So one example we had is a client didn't run this test at all, and their exec only benefits enhancements that triggered penalties. So the tip is, and the key is to make sure that they run the 105 testing, the non-discrimination testing annually, and anytime that there might be a change in benefits, even if it's mid-year.
Understood. Okay. And who is ultimately liable if something goes wrong? Is that the employer?
Yeah. No, absolutely. Yeah, the employer is ultimately liable if something goes wrong. And that's the case on a fully insured plan too. But that's why legal must be at the strategy table from the beginning, not just when things go south. So, another tip or thing to remember is, consider a compliance calendar. And we provide those to all of our clients and include legal in the TPA selection from the beginning. And of course, review your fiduciary insurance limits. Obviously, getting a fiduciary insurance policy is important, but you also have to review those limits every year to make sure they're adequate.
So what I've seen, and this is what surprises most legal teams, fully insured plans don't protect you the way you think they do. There's no appeals discretion. There's no visibility into claims or prescriptions, and no contract alignment with your values. So if you want to actually protect your employees, say in a medical emergency, you need control. And that comes through owning your plan, right?
Yeah, no doubt about it. You can't you can't manage what you can't measure, and you can't measure what you can't control. That's really
Absolutely.
that's the bottom line, right? I mean, so what we're talking about here in a self-funded model with a captive, there's a lot of protection for mid-sized employers, even large employers within a captive, because you got this co-op, pool and this ocean effect that, prevents you from having, highs and lows in claims. Of course, we got stop loss and individual stop loss, aggregate stop loss, all these things that are built in to protect. But, the bottom line is people want to know what changes and what doesn't. So let's maybe talk a little bit about that. So first, let's talk about what doesn't change. So when you're in a fully insured plan, you have the comfort and I guess the consistency of the networks, right? So you have a network, you have a name on the card, whether it's Blue Cross, Aetna, Cigna, United Healthcare. So that doesn't change. TPAs, we work with the same carrier networks, and those networks are available whether you're self-funded or fully insured. Then you got your benefit structure. So that doesn't change. In fact, you have a lot more flexibility with your benefit structure than you would on any fully insured plan. So you can technically, we can customize it and we can build a plan based on your exact needs and requirements for your company. Then you have your human resources information system, the HRS system, and the portals. Well, so where employees are currently going to log in for open enrollment, new hires, changes, what HR uses to manage their benefits administration, all that's the same. So we have a lot of employers that are on Workday, Rippling, Employee Navigator, Paylocity for payroll, you name it. All of these vendors, there's a lot of great ones that are very tech savvy, technically enabled, and the TPAs work with them as well, the TPAs that we choose and partner with. So it really keeps everything aligned and consistent so it can be completely integrated just as it is today. And then when you have member support and you have member support lines, actually that can even get better than what it's currently available on a fully insured plan, because then we can start to build in care navigation and concierge services to help members be proactive when going in for services and help guide them so they can get to maximize their plan's value and even lower their costs when they go see a provider or go to a facility. So there are some things that do change though. And as we talked about quite a bit, you can't manage what you can't measure, right? And you can't measure what you can't see. So when you are self-funded, what does change is your control. You control the dollars now, right? So you have the visibility. You actually get to review claims. You see the data actually in real time, and you get to manage pharmacy. So what pharmacy, basically when you talk about managing pharmacy, you get to determine what's on your formulary. You don't have a carrier telling you that this isn't a medication that's covered. You can pick and choose what medications that you want covered. And if your employees need something special, you can actually build it into the plan and make it a covered benefit and put it on the formulary. And of course, you see the data. So, and all of that allows you to stop waste before it happens.
No, that's a good point. So let's land this plane with something practical. Okay. So if you're sitting on the legal team or you carry a fiduciary responsibility, this is what a real advisor should be doing for you. The first is they should be redlining every vendor contract, not just glancing at them, but actually redlining them. That's the TPAs, the PBMs, the stop loss carriers, care navigation partners, tech vendors, that's all of it. And they're not skimming for pricing. They're focused on the stuff that actually exposes you. And those are indemnification language, liability caps, breach response obligations, and who's on the hook when something goes sideways. And the second is they should be conducting a fiduciary liability coverage review. And that means comparing what you have today, stress testing it against real world risk, and recommending appropriate limits and helping you purchase coverage that actually protects the decision makers, not just checks a box, right?
Yeah.
The third, is they should be auditing your plan documents every single year. That's the SPDs, the plan documents, wrap documents, required notices. And if any of it is more than 2 years old, you're operating on borrowed time. And that's just the experience I have. and borrowed language as well. And fourth, they should be building and managing a living compliance calendar, Form 5500 filings, non-discrimination testing, SBC distribution, HIPAA, COBRA, PCORI, and not will remember, not we think it's handled, but actually scheduled, documented, assigned, and provable. And finally, and this is the part most advisors never talk about, is they should be aligning your plan documents with leadership's actual values. So if you want to override the authority, we write it in. If you want consistent appeals logic, we codify it. If you want employer protections baked into the plan instead of left to interpretation, we draft that on purpose. So this is what fiduciary grade advising looks like, not selling plans, not pushing products, but designing a structure that actually holds up legally, operationally, and ethically when it's tested.
Yeah, let me stop you right there before we continue. I just want to chime in with a point. So all the things you just mentioned are super important, and one of the main reasons why we put this podcast episode together is to really shed light on these important things. And you laid out really the 5 key things that every HR team, every legal team, every CFO, every board of directors needs to be aware of. So this is super. I hope people are listening, and I hope they reach out if they have any questions.
Yeah, I just want to add one more thing before we leave is this. Self-funding, it's not a destination. It's the starting point. It's the moment you stop renting a system that be, fully insured plans you can't control, and you start owning one you can actually improve year over year. So because once you own the plan, you, like you mentioned, you gain visibility, that you can see the data. And with the visibility comes leverage year over year. And with that leverage comes better decisions, right? So this series, it's not about selling a funding model. It's about giving employers a blueprint, a smarter way to measure and manage and improve benefits over time. So if today's episode raised questions or confirmed what you already suspected, don't wait for renewal time to panic. So the best time to evaluate options is before you're under pressure. And so at Triforta, we don't pitch. We help leaders think clearly, map the risks, and decide what actually makes sense for their organization. And if you want clarity, not hype, feel free to reach out to us. Start a conversation. There's no obligation, just a working session. This is Blueprints for Better Benefits, and we'll see you on the next one. Take care.
Yep. Thanks, everybody.
All right.